Welcome back. I am pleased now to actually welcome Felicia O'Neill, AVP of Business Development of Computershare, PCMA's premier partner, to introduce you to you, our final keynote speaker of the day. Felicia, thank you so much for being with us today.
Thank you, Nancy, for that lovely introduction. Yes, I'm Felicia O'Neill with Computershare, and being a PCMA Premier member partner is always an adventure for us, especially at conference time. We get to be introduced and speak and meet with top industry speakers, and today is no exception. It is my absolute pleasure to introduce our keynote speaker today, Dr. Bikram Mansharamani. Hopefully I said that right, Bikram. I did my best. It's a pleasure to meet you virtually. Thank you. Bikram is a global trend watcher who shows people how to anticipate the future, manage risk, and spot opportunities. He is the author of the recently released Think for Yourself, right behind Tommy there, Restoring Common Sense in an Age of Experts and Artificial Intelligence. He has been a frequent commentator on issues driving disruption in the global business environment. Bikram's ideas and writings have also appeared in Bloomberg, Fortune, Forbes, the New York Times, and a long list of other publications. LinkedIn has twice listed him as their #1 top voice for money, finance, and global economics. And Worth has profiled him as one of the 100 most powerful people in global finance. Bikram is currently a lecturer at Harvard University, which I have visited and I love, where he teaches students how to use multiple perspectives in making tough decisions. Previously, he was a lecturer at Yale University. In addition to teaching, he also advises several Fortune 500 CEOs to help them navigate the radical uncertainty in today's business and regulatory environment. He has a PhD and 2 master's degree from MIT and a bachelor's degree from Yale University. Today, he will show us how our complex data-flooded world has made us more reliant on experts, protocols, and technology. Bikram will illustrate how we have outsourced our thinking to a troubling degree, and as a result, relinquishing our autonomy. Please help me welcome Bikram Mansharamani.
Hi, everyone. Thrilled to be with you.
Well, Vikram, I'm going to take it away. It's my turn. And I got your book right here. I have one issue I have with your book. It's amazing. There's one issue. You've been to Vegas 70 times and no bachelor parties and nothing in here about that.
Yes, for those that are listening, Tommy's hinting at something from my past, less these days, particularly because of the pandemic. But Vegas has a very soft spot in my heart. I, in fact, wrote my dissertation back in graduate school, 20 years ago, when I was at MIT, about the gaming industry and their use of technology and data to manipulate how people think and what you do with your money. So it sounds unrelated, but it's kind of related. But yes, Tommy, a fun tidbit of my past. Thanks for bringing that up.
Sorry, you got to catch you there.
Yeah, that's good. That's good.
So let's get right into the book. I've read it. I've read it twice, to be honest with you. Let's start with you open up your book with the fox and the hedgehog, and I see the fox in the back there.
Right here. Here you go. Yeah, Tommy, it's interesting. This sort of dances throughout the book, but it actually goes through all of my work, even my prior work on financial bubbles and my belief in navigating uncertainty. And the fundamental belief that you're hinting at here is that when facing uncertain or probabilistic dynamics, it's often better to be a generalist rather than a specialist. And if you go back into ancient Greek poetry, and then, obviously later with War and Peace and sort of critiques of it, there was this logic of the fox and the hedgehog. And the fox is really the generalist. They know lots of little things, foxes. And a hedgehog is a specialist, knows one big thing. And so I've often identified myself as a generalist, and I encourage others to adopt what, the title of the TEDx talk I did years ago was called The Power of Foxy Thinking, for this exact reason, right? Which is the fox is a generalist. It's the animal world's version of someone that knows lots of things and is able to focus on connecting the dots rather than merely generating the dots. So anyway, thanks for bringing that up too. That's another fun tidbit right here.
I'm 2 for 2.
There you go. Yes.
So getting to your point about generalists and specialists, depth versus breadth. It's exactly the point that we see these days. I mean, with Google, there's no more encyclopedias. Companies are looking for individuals, and you could comment on it, individuals that are more generalists, that, just have enough knowledge to be able to know where to look or where to get that information to be able to make decisions. I'll leave you with that.
Yeah, well, it's interesting, Tom. I mean, I would hint at you're right in the sense of what companies are looking at, but I don't think technology necessarily is making that better. And the reason is, think about how you read your newspaper or your magazines today. And if you're reading them electronically, it allows you to tunnel in directly to your topic of interest. You're not getting exposure to the adjacent topics that you might otherwise stumble upon or see as you're going through it, right? And so the result is, so here's an example. Current on my desk right here, the Current magazine, the Current Economist magazine. I don't read it digitally. I don't read it digitally because when I do, I go right to the areas of interest. When I read it this way, oh, look at this. There's a civil war brewing in Ethiopia. I didn't know that. Oh, Central America has some stuff going on. I'm forced to sort of, even passively, maybe not very deep, but in a sort of an exposure sense, get the big picture. And that's why I actually encourage people, when consuming information, particularly from periodicals, I'm a big believer that it's worth consuming the original physical format. I still read newspapers. I still read magazines. People think I'm antiquated, but there's a reason behind it, which is it forces me to get broad exposure, even if it's just skimming the headlines while I search for mine. Whereas if, let's say I'm interested in US-China tech policy, I could just Google search that and I find all the articles I need. Well, am I going to necessarily get exposed to the information that, oh, actually, Ethiopia, Africa, there's some tensions building, there's some issues there. Maybe, maybe not. You might argue it's irrelevant. I'm going to suggest that if you want a global perspective, it does become relevant.
Yeah. No, and you're right. I mean, you just look at it, you go on Netflix or Facebook, and you're looking at CNN and you're getting all the CNN related stories. If you're Fox, you're getting all the Fox. If you're conspiracies, you're getting conspiracies, and it just reinforces what the individual is looking at, instead of having this debate or looking at the other side and saying, that's interesting. I mean, the fear of too much information, like we say.
Yeah, well, you know what it is we've seen what might be called the death of nuance, right? We've lost that middle ground, and it's creating these echo chambers. And so you hear your own beliefs rebounding right back to you, and so you believe them more. Frankly, I think that's part of the reason, at least here in America, we've had such strong polarization. I think social media is contributing to that in a negative way. So one of the things that I, again, recommend, and I'm hopeful some in the audience will adopt this, is if you are reading and consuming news through algorithms such as Twitter feeds or Facebook feeds or what have you, make a point of either, again, in the world of Twitter, make a point of following sources of news that you are less likely to agree with. So if you're a devout believer that you should read CNN, you know what? Follow Fox News as well. Follow BBC, follow The Telegraph, follow the South China Morning Post. Why? Because, and by the way, don't just follow, click on them. Click on articles and links from them, because the algorithms are designed to feed you what you're likely to click on. And so if you confuse the algorithms into showing that you have a diversity of interests, you'll get a diversity of ideas in your feeds. And that is actually constructive, particularly if you want to navigate uncertainty.
And and all this uncertainty and all that, how does that come to play with investments? We're the Private Capital Market Association. How do you link that back to investments right now?
Oh, Tommy, navigating uncertainty is a everyday occurrence in the financial markets. For sure in the public markets, but I would argue in the private markets as well, for various reasons. And again, we can drill down in whichever area you want to. But for instance, one of the things that I've said, in my book, my prior book, Boom Bustology, and even I hint at it in Think for Yourself, is, it's when you outsource your thinking to something that is so certain that you're likely to lead yourself towards trouble because you don't ask questions. You're not actually thinking for yourself. And so the example I use in the world of investing in the book is think about the passive investing phenomenon that is so prevalent in the world today. I talk to endowment managers, foundation managers, sovereign wealth fund, pension fund managers, individual investors. Virtually all of them will say, we believe we should minimize costs and just take a passive index exposure. It's almost become religion in the sense that people don't question it. It's of course the right thing to do. But if you think for yourself and actually connect the dots, I ask you, what would happen if every single person was passively investing? Well, the whole price mechanism would break down. You'd see massive misallocated capital. Becoming a member of the index would matter more than the fundamentals of your business. And so all the power would go to the index designers. By the way, interestingly enough, here as we're speaking in mid-November, Tesla was just inputted into the S&P 500.
You went too quickly for me. I was going to bring that up.
Oh, perfect. Well, this is my point, right? Which is a company that was, one might argue, overvalued, was up, 15, 20% in the last day or two since it was anointed as being a future member? I mean, this is telling you that the power of indexes has risen potentially above the power of fundamentals. And so that's a problem. It results in misallocated capital. And so I actually think, to connect it actually to your audience a little more directly, Tommy, I think it creates better opportunities in the private markets because there's more rationality, right? I mean, you don't have this gross irrationality that comes from what I would argue is a passive investment bubble that's been brewing and therefore distorting prices. Now, you might have other problems in the private markets, right? With too much money chasing too few deals, too many SPACs raising money to come after private enterprises. There's a lot of other issues we can highlight. But at least this passive index component distortion is not prevalent in the private markets.
No, and you're right. And you see a lot of articles that are saying active management is back. Everybody's price taking, price making, fractional. Robinhood came out with fractional trading. Now you're just buying $5 Apple. You have no idea what price it is. You're just putting $5 because you have $5. And I think I read one place, I was like, you could even trade for $1. You buy Amazon for $1. Yeah. Just getting ridiculous at one point, no?
Yeah. Well, it's if you factor in that phenomenon, which is free trading and fractional purchasing, combine that with some of the dynamics we've had. In fact, take the SPAC phenomenon, these special purpose acquisition companies that have become quite the rage. Think about what that is. I am so comfortable and confident in the future. I'll give you money, not even knowing what you're going to put it into. What?
Yeah, you're right.
I mean, literally what you're doing, right? Isn't it? We're comfortable. I trust you. I'm going to invest money in the idea that you're going to find something to invest in. Huh? Sort of interesting, right? Now, there's some protections, of course. The money stays in a cash, and there's some warrant coverage, and we can get into the nuances of that particular dynamic. But the overall storyline is ridiculous confidence in thefuture economic and financial returns, predominantly driven by these assets. So,
stick to the topic of the financing and private versus public. Globalization, deglobalization, or decoupling of the world is a big topic with Canada, U.S., China trade. I remember at the CFA conference you mentioned, I think it was something like 90% of active pharmaceutical ingredients are made in China, and risk management is going to become really key. How is this risk management approach moving forward into investing going to be valued within fair value of any assets that you purchase?
Yeah. So I don't want to repeat everything I said, but I do need to give some background here, Tommy. So let me take a minute, if it's okay.
Yeah, go ahead.
To articulate the thesis. So the overall thesis is the world has gotten to the point where the U.S.-China rivalry has risen in tensions enough to say it is a great power rivalry. That's what it is. It is not merely a trade war. It is not merely a tech war. It's not merely a space race and a currency war, an economic race, an arms race, etc. It's all of the above. And the result is, I believe, at this point, the single most important geopolitical development underway in the world that should affect virtually everyone and everywhere is the US-China rivalry and where that goes. The implication that I've talked about before, that I'm happy to discuss more of here, is I believe that forces an existing trend to escalate and accelerate. Now, what's the existing trend I'm talking about? I'm talking about the deglobalization that was happening as supply chains shifted away from China. Think of it this way. Let's imagine that you have a manufacturing operation in Canada and you have some key components coming from China that wind their way through a long supply chain. Maybe they go through the United States and eventually they end up in Canada at your manufacturing facility. Now the trade war starts back in 2016-17. And suddenly there's tariffs on key components. And so you can still get your components, they still arrive, but they're now a different cost structure. Hold on, my business model of manufacturing this good said that this widget piece that was coming in was going to be $7. Now it's $34 because of all the tariffs and extra expenses. Now my business model's out of the way. It doesn't make me feel comfortable. I need to find a different source where I don't have that geopolitical risk. Then COVID-19 comes along. And suddenly the supply chain is actually disrupted. Availability matters more. So suddenly you say, you know what, we really need to change our supply chain. Let's bring it back closer to home. Throw on top of it the dynamics around environment and sustainability concerns, and you start thinking about the climate footprint or the carbon footprint of your long extended supply chain. And you say, you know what, a shorter supply chain is probably better. All of this brings you to a dynamic that's shifting, where previously we had a just-in-time, lowest-cost strategy to managing global supply chains. Today, we're shifting to a just-in-case, most resilient supply chain logic. And this is flying through at least the corporate boardrooms I've interacted with virtually unanimously, that we need to increase our resilience, that actually matters. And so, you know, you hinted, Dami, excuse me, you hinted at some of the other concerns I raised that are further, you know, intensifying this trend. And so one of the other dynamics I've talked about is national security concerns. And so you're right. I mean, I think it's 90% plus of antibiotics, vitamin C, acetaminophen, hydrocortisone. There's a bunch of different ingredients. I forget the exact percentages, but a disproportionate percentages of these key pharmaceuticals or over-the-counter medications that play a really important life in the lives of Americans. Again, I don't know what the numbers are for Canada, but for the lives of Americans, are coming from a supply chain that goes through China. So that's a problem, and that's going to change. And I think that's one of the things I was hinting at.
Yeah. But my question I want to follow through is, the world's becoming, you know, it's become increasingly interconnected. You know, you see with COVID, you know, it's a pandemic that could have maybe, if the world wasn't as connected, you know, you grab a flight, you're in China, within, you know, 24 hours, you're in the US. How did we get to this point that we underestimated this kind of risk, or we just left it? Is it political? Is it businesses? Is it individuals? We just kind of let it go?
Yeah, so a couple of things. Number one, I do think we're in a world that is, I wouldn't call it deglobalizing, but I would call it bifurcating. So we may have two global systems that coexist, a Chinese-led ecosystem and a US-led ecosystem. And, you know, for various countries, when I talk to them about this, I've met with different government departments and leaders around the world. And, you know, when I talk to them about this, they're very uncomfortable. You know, Middle Eastern countries will say, well, hold on, I want to sell the oil to the Chinese because they have good, you know, demand and I want their money. But I like the American military protection. And I say, okay, that's fine, but are you going to use Huawei or not? Because that's your choice. You're going to be forced in one way or the other. And that's just one example. So I don't think that we're going to find ourselves with the old school, very isolationist, individual countries trying to be self-reliant dynamic. I think we are going to continue to have trade, but I think there's going to be this overlay of which ecosystem you may exist in. Now, to your question of how did we get here and the vulnerabilities that it exposed, I mean, this is the problem of progress and efficiency. There's a trade-off between resilience and efficiency. And the more efficient you get, the less slack you provide, and the more tightly coupled you become. That makes a disruption ripple through the system that much more quickly. And so, unfortunately, our quest for efficiency came at the expense of resilience, and that resilience was needed when a pandemic hit. So I think that's part of it.
Shift a little back to what the private markets is all about. Here in Canada, we have an economy that's focused a lot on real estate and financial services. A lot of our GDP is represented. Can't remember which organizations quoted that Canada has the two real estate bubbles brewing right here in Vancouver and Toronto. What's your take on the real estate market, if you can, in Canada or in general?
Yeah, well, it's interesting. So let's start, Tommy, with an area I feel I understand a little better because it's more commonly discussed among institutional investors. So let me start there, then we'll go to but when you talk about commercial real estate, think about some of the trends that were in place, specifically in office, and we can get more specific than that later, but think of what was happening in major urban office spaces. You had a company that was very prominent, exciting, popular, called WeWork, that was accelerating this co-working phenomenon. People had realized that there was all this underutilized capacity in the office space, so let's just squeeze more utilization out of it. And so co-working became a phenomenon which on the margin decreased demand for office space. In fact, at one point, WeWork was, I think, the largest tenant in Manhattan. I mean, this is a big 10% of all office space. Crazy numbers. Well, WeWork stumbles, but co-working potentially accelerates, and the basic underlying trend of maximizing, becoming more efficient in our utilization of office space actually got a dose of a shot of steroids, because now we're all working from home. And so it's like co-working juiced up on, extraordinary levels of steroids to be really intensified. I mean, the phenomenon, think of where we are here right now, all of us virtually, right? What ballroom is being used? How many people are in offices with colleagues? So it's a different dynamic. Now that puts downside pressure on the demand for real estate. So all else equal, demand is, at least in this office domain, less needed. Some large US corporations, some of the largest companies in the world are talking about reducing their footprint in terms of real estate needed by 10, 15, 20, 25%. And it's because of this pandemic that's sort of unveiled that. Now, the flip side is that, and I'll try to hypothesize, I don't have great data on the retail side of things, or sort of the individual residential real estate. Well, if you're not going to the office, you have someplace you need to work, right? So you might want to work from home, and therefore you might want a little more extra space. So you could imagine a demand shock on the residential side, where people are saying, I'm spending more time at home, I want more space. Kids are going to school here, I'm going to work here. This is we need a little more. So, there's some cross currents there. Now, low priced money is often mispriced money, and mispriced money is often misused money. And so if money costs too little, people use too much of it. And I fear that might be happening in certain segments of real estate, where the access to credit becomes so easy, and this speculation and the fervor of overconfidence, particularly in residential, condo trading, etc., has become so common that it's effectively greed has won out over any worry or fear. And so that does lend itself to some bubbly dynamics. I don't know the specifics of Vancouver or Toronto, but it wouldn't surprise me to hear that they've gotten ahead of themselves. Doesn't mean they won't grow into it. It just means that they may be ahead of themselves. That wouldn't surprise me.
So that being the case, I'm just thinking, what trends do you see? I mean, if real estate credit is so easily accessible these days, is it because other opportunities are not being presented themselves? Is it the demographics right now? There's a lot of more of the developed countries that are not having enough. The birth rate is very low. So there's I think UK, even Canada announced they're looking to have a large influx of immigrants, especially coming out of Hong Kong with everything that was going on over there. Now, we're not going to get to politics, but what do you see as a trend happening, and how we could relate to that into the private markets as well? A lot more entrepreneurs coming out. I mean, I asked 4 questions, but
Sure. No, but look, I think it's interesting concepts that you're hinting at here, which is, why is this sort of real estate excitement so high? And are there some dynamics that are supporting it? Immigration obviously drives demand for residential real estate. More people come in, they need more places to sleep. If you don't increase supply dramatically, then therefore but you can also think about it as well. The supply may be constrained. Again, I don't know the specifics of what's happening in Toronto and or Vancouver, but the pandemic has sort of put a little disruption in sort of the availability of labor to go build. And there's some, things are still getting built, construction is still happening, but some of it's slower. Non-residential happens to be faster. So there's cross currents there, but there may be a supply disruption that could help explain part of the story. In terms of banks and where they can deploy capital, at least, if you look at global liquidity conditions by looking at the different banks and you add up, there's an unbelievable wave of global liquidity that needs to find a home. And for better or worse, real estate tends to be a secured asset. Now, I would argue that it's not as secure as people think, because values go up and down. And if I lend you 80% loan to value today and the property falls 30%, well, how secure was that? Maybe less than I thought. But that aside, the underlying fundamentals of real estate are usually driven by cost of production. So that's the supply-demand story. Demand being driven by immigrants, population, demographics, et cetera. So that's actually an important consideration to keep in mind and to keep focusing on. And then, any policies that may exist and the government's role. And that could be either manipulating the cost of money down to be too cheap. It could be providing housing incentives to try to, whether it's a mortgage interest deduction or an accelerated depreciation for investors or what have you. There's lots of different things there. So those are my thoughts on real estate. Now, you were asking also about entrepreneurial activity and sort of the availability of investments. And I think that, one of the things I have found and witnessed and watched over decades is there's always entrepreneurial activity. There always is. There always will be. There are entrepreneurs with good ideas constantly. There's no shortage of ideas. Problem is, there's the shortage of putting the right ideas with the right capital at the right time in the right place, et cetera. And so, I'm very optimistic that there are, throughout all of these dynamics, good ideas worthy of investing in, worthy of deploying capital against, that will generate high positive returns. I think that's going to exist. Now, the amount of capital in the private markets that are chasing some of these opportunities is perhaps mismatched, right? There may be segments where there's a lot of capital. For instance, today, if you decided you wanted to put private capital to work in the electrification value chain, batteries, power storage, electric vehicles, et cetera, there is a lot of capital chasing that. Going back to the SPAC dynamic we started talking about, I understand there's 200 and some odd SPACs that have not yet merged that have something like 80 something billion dollars of money just sitting in cash waiting to deploy in these private companies. That's a new form of competition for the private markets, right? These SPACs. And then you've got, of course, tons of money that's been raised by private investors in private equity funds and venture capital firms and growth equity funds and just private individual family offices investing directly. So there's a lot of capital out there. But there's also a lot of good ideas.
You mentioned there's a lot of capital. I'm going to go back to that because you're right. There's a lot of capital. Aging populations, their competition for that capital has driven down interest rates. We had 16 trillion of negative yields at one point. That's scary. Those are scary numbers.
So I'm going to stop and ask you, Tommy, what's the problem with negative interest rates? Why do you care?
No, I mean, I think it's great because you don't leave your money in the bank. You got to do something with it. It's got to work, and then you're risking capital to put it out there instead of sitting in the bank and earning.
Does negative interest rate
make sense to me? Well, 16 trillion. There's a lot of money. There's a lot of money. It makes the logic behind it to leave it there parked and earning an interest on government bonds that the government has to take it and do something with it. Better to, you want to keep it there. You don't want to risk it, no problem. But you're not going to earn anything. You're gonna earn less. I get it, but I don't. I mean, you're the guy that.
It's interesting. So a lot of times people tell me the question comes at me this way, which is, oh my God, there's 16 trillion of negative interest rate. That doesn't make any sense. Why does that exist? It's horrible. Like, what is going on in the world? Vikram, help us. And I say usually there's a couple things to think about. Number one, okay, so it might be negative in nominal terms, but maybe in real terms it's still positive. Maybe we have deflationary pressure in the world. In fact, demographics, technology, globalization, all these dynamics have suggested downside pressure on inflation. And in fact, we've seen deflation in many areas. So it's actually not negative. You're just confusing nominal and real rates. So that's number one. Number two, that's one possible explanation. Another possible explanation is, Tommy, suppose you want to store your money in gold bars. Well, you're going to put those gold bars in a safe. You're going to maybe have a guard stand outside and protect it. There's a cost of carry. Let's say you want to keep your value in oil. You hire a tank farm and you fill it up with oil. Well, there's a cost for that tank farm. You want to keep your money in grains, and so you park it in silos because you believe agriculture is the future. Grains are always going to be needed. Well, there's a cost of maintaining the grain silos and pesticides and protect. So there's a cost of carry. Why should money be any different? The bank has to pay for cybersecurity. They have to have the electronic infrastructure. They're making sure it's there for you. They're going to make sure the records are being kept. They're handling the customer service inquiries. Surely there's a cost to all the business they're doing. Shouldn't you pay something for it? We're not saying a lot, 50 basis points, something like that. It's on demand, available to you. So actually negative interest rates are very logical in some sense, if you think about it that way, right?
No, I agree with you on that point. I mean, to your argument that banks should be covered, they've always been covering. They've always covered fees. They've always, with the interest rate spread, they've covered it. That I agree with you totally. But when you look at it, how do you value when you're an asset or discounted cash flows with a zero?
Yeah, so you're right, exactly right, Tom. Now you're getting to the interesting part. So that's one side of me. I can tell you why negative interest rates are great. Obvious, logical, no big deal. What's the problem? And then I can also flip my hat around and I tell you a different story. Tommy, this is crazy. I don't understand negative interest rate. When I went to college back in the 90s, I learned that interest rates were compensation for uncertainty. $1 today is more certain in my pocket than you telling me you're going to give me $1 tomorrow. So if you're telling me you're going to give me $1 tomorrow, I want to have $1.05 because there's uncertainty. The future is uncertain. Therefore, give me higher interest rates on my money so that my time value matters. Well, negative interest rates are saying that tomorrow is more certain than today. What? I don't even know what that means. I cannot even, my head hurts when I think about this. Like, I don't know what it means. So if we think about that, then you sort of get confused. So wait, what are we talking about? I don't even know what this means. Makes no sense. So herein lies the disconnect, is that there are different silos and different interpretations that may or may not make sense within each silo. And it's only this integrated view that lets you see why we got to where we are and the sort of, let's call it distortionary impact of it. You're right. It's forcing people to take more risk than they otherwise should. Yeah, that's true, right? If you're a pensioner and you need the interest rates, many people over many decades said, if I save $1 million and the interest rates is 2%, then I'm going to get my $20,000 a year as dividend payments that'll come or interest payments that will come. I'll clip the coupons and I can live. Now, you're not clipping coupons. You have to send the coupons in. What? I don't understand. I've retired. Now I have to pay the government. What? Huh? Anyway, that's the world we're in.
Yeah. Before we get I see some questions coming in, but I just wanted to go back to the, how the valuation, we touched upon it right now, obviously with 0 discount rates, and also the whole thing of the asset allocation in the portfolio. We've been, the last 40 years, efficient market theory, 60-40 portfolio. Suddenly people are coming out saying, well, more 75-25. Private markets, alternative investments, democratization of alternatives coming out, all these buzzwords. What's your take? We're private markets. We have investors on the call. We have, representatives meeting investors. They're looking at it and saying,
Sure.
where do we go in the future? I mean, there's a new reset. The reset's happening.
Yeah, so one of the things I think is fabulous about private markets and private capital markets, and I'm a big proponent of them as a role, they play a very important role within portfolios, is I actually like the illiquidity of them. Now, why is that, Tom? I like the illiquidity of private markets because it encourages longer term thinking. And I think the private markets offer something which is naturally friction, if you will, in the gears of this dynamic of short-termism that's sort of spreading everywhere. And, so I appreciate that because that actually forces real positive investment cycles that generate improvements to economies and sort of the productive capacity of a particular country or a region or industry or what have you. So I love that. I love that. That's a genuinely positive thing to do versus some of the other domains that are popular in asset allocation of, oh, I got to have an X% allocation to the S&P passively held. That's just passing money around back and forth versus deployment of capital to generate new ideas, new businesses, new markets, new opportunities. So I think private investments will always have a role in a portfolio. I do a lot of work with asset allocators, and the one thing that does concern me is many asset allocators sort of grew infatuated with what they call the Yale model, right? So David Swensen at Yale came up with this idea of take illiquidity and sort of, find idiosyncratic assets, uncorrelated, a couple other things. Many of your audience, I'm sure, is familiar with it. But David also has a very strong team to evaluate all those things, right? He's got a world-class team of professionals supporting that process. One guy sitting in a room by himself in a family office somewhere, I don't know where, anywhere in the world, cannot replicate that level of effort. Just can't. And so it might make some sense to not pursue private investing in certain situations. And so again, not knowing everyone's situation, it's hard to give generic advice, but what I can say is private investing, private markets are a genuinely good thing to have in a diversified portfolio.
Should private markets be considered a separate asset class on its own, part of alternatives, or part of alternatives?
Yeah, now you're getting into semantics. I don't have a strong view.
I'm sorry.
No. It's just, my point is I don't have an opinion. Tommy, I'm not trying to be negative. I just don't have an opinion.
I'm kidding. I'm just bugging.
What you call it, I mean, people can call it whatever you want. I don't care, right? You want to call it an alternative, you want to call it an actual exposure. I mean, you want to say 70-30 and 70's equity and 30's debt, and then of that 70 some is private. Like, I don't know. It doesn't matter to me what you call it. There's a role for it. I think there's an important role for it. And if you're thoughtful, if you're thinking for yourself, there you go. Then
there you go.
you're going to think of private investments as part of a portfolio. And you won't worry as much about box checking to put it in a particular domain. So
I'm going to jump in some questions here because I'm getting a few of them here. One of them is a question of, obviously the person is a scientist and is asking the question about misinformation driven by clickbait media is confusing layman people with very complex science, blah, blah, blah. You know where I'm going. The question is, how do scientists, fight back versus what the media is putting out there with all this clickbait? We saw the whole chloroquine versus, the scientists saying so, no, and well, you know where I'm going with that.
Yeah, well, look, so it's a great question, Tommy, because as you know from reading my book, that the essence of my book, Think for Yourself, really is a message about how to manage experts, and that how do you navigate uncertainty with people that know more than you do about their particular domains. And it's been my belief that dismissing experts is as problematic as blind deferral to experts. And so the logic I suggest is we need to keep experts on tap, not on top. So now you come to the idea of experts and COVID and misinformation. Yes, there's a lot of it. The clickbait algorithms and sort of the reasons and how social media gets compensated, that's a topic we started hinting at. I'm happy to come back to. That is problematic. Yes, 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 I agree. That requires regulation. That requires possibly more draconian self-education on the part of individuals to understand the algorithms and how they're trying to put things in front of you that you will click on, or even possibly regulating some of these algorithms. That's a different topic, bigger topic. We can go there. But the question about scientists. So I think it's really important that leaders specifically think about things beyond the domain of any one expert. So, for instance, let's take the COVID dynamic, which is currently, glaring around the world. We all know the public health professionals will say you want lockdowns, wear a mask, keep people apart, socially distance, close the restaurants, no late nights, all this other stuff, less travel. And so lockdowns are what a public health professional would like you to seek. Now, if you're the leader of a country or a state or a municipality or a city or what have you, that's easy. You just follow the experts. But there's a competing trade-off. There's a trade-off let's just stick with health, in the non-public health. What is the cost of a missed mammogram? What is the cost of someone not getting their teeth cleaned? I don't know what it is, but it's not zero. It's not zero. There is a cost, right? So we have to start balancing this. Now, what about the economic cost? You shut down an economy. Well, that's huge. We know that what about the mental health cost that comes from isolation and then the loss of jobs and the depression? Okay, that's also big. What about the political costs of sort of the bifurcation of any community spirit? And suddenly now I look at everyone who coughs when they walk down the street. I'm sort of, hey, that guy's there's some problem. Yeah, stay away, right? There's a sort of individualism that comes at the same time that you're trying to get a community spirit. So there's these trade-offs that come. So the reason I bring this up in this logic is I think experts, scientists, etc., have an obligation to understand the domain in which their decisions and advice are being offered. So if you're a public health professional, you say, yes, I recommend a lockdown, but we know there are costs. So at the very least, what we want to do is have everybody wear a mask. That is at the very least, we need that. We need to have, for instance, availability of masks everywhere. Anyone comes out, doesn't have a mask, have them a mask, have it available. And then have, hand sanitizer or whatever everywhere. And so simple things that they can say and say, look, as and when available, if it doesn't affect people's economic situations, they can and should work from home. We realize some people can't. That's okay. Let's take extra precautions. We don't have to do a lockdown. Let's protect the vulnerable rather than lock down everyone. So there's different approaches. And I think public health professionals should have that sense that they are a part of the solution, not the entire solution. That this is much more complex than any one expert can provide. So I'm not suggesting we dismiss science by any stretch of the imagination. I'm just suggesting that we take the science and we balance it with some of the other competing alternatives, but that could be scientific, right? I mean, we know some of the preventative health, the mental health issues, those are real. Those are real. And yes, COVID's real too. And so if they're competing, there's a balancing act, and there's no obvious answers, unfortunately. So that's really what I would say there. But look, all of us should try, and I say this in the book, we should all triangulate multiple perspectives. And that makes this disinformation less likely to get through to you. If you hear about something, you read about something, it's from a source you don't understand or recommend or trust, go to a respected source, right? Get a medical question, go to the mayoclinic.org or .com, whatever it is. There are sources that you can trust and that you probably have confidence in. And so I always say, go to multiple sources, because that's ultimately how you'll triangulate the insights.
But why is the message being not conveyed in the way you just described it? I mean, is it because of what you discussed earlier, that you look at the things that reinforce your position or your opinion, or is it just it's easier to sell? For the media, it's more sexy to sell.
Yeah, of course. The media. Look, where you get your information is they all have business models, right? The media needs the eyeballs. They need the clicks. That's how they're getting paid, right? So there's part of it's that there is a natural sensationalism that overlays all of this, and that's part of it. Unfortunately, we don't have to like it. We just have to acknowledge it. But you can try to combat it when you can by using multiple sources. So that's the way I think. And then I don't know this for sure, Tom, but I get the sense there are political motivations to produce particular views as well. And that's a domain that I try to stay.
We won't go there. Won't go there.
I try to stay apolitical. But yeah, there's something there.
I get you.
Yeah.
We have different types of people watching this right now. We got investors, we got representatives, we got people from the industry, professionals.
Yep.
If each one of them, you can give like a little message based on your book or your experience, expertise, what would you tell investors moving forward? What to look at? I mean, do you make a portfolio on yourself? Do you follow passive investing? Do you look at active management? For representatives, do you rely on better due diligence? Do you look at, what would you tell each individual one?
Yeah. So what I would say is this: there's a generic logic that I would put over all of it, because obviously everyone has different objectives, different needs, different portfolios, different goals, etc. But there's a section of the book where I talk about goals-based investing and being mission-oriented, right? So I use examples from the military and other places, but the conclusion I come up with is actually to think for yourself means that you are mission-oriented. You stay focused on your goal, your objective. And that sounds sort of obvious, almost trivial, right? Of course I am, Vikram. Well, think about what we just said with the media and the consumption. The media has their goals. They may be different than yours. The doctor who's treating you may have his area of expertise and focus. Maybe he's taking care of your heart. Well, you know what? The heart's part of the whole body. And so, the cardiologist sees a piece of the picture, not the whole thing. You need to own the whole thing. And so likewise in investing, if you're an individual investor and you're trying to save for a child's education, well, that's your goal, the amount of money you need for the education. Don't try to maximize. Instead, satisfice. So focus on satisfying or achieving that goal. That may mean that you give up upside by selling a 20-year option, a call option. That's probably worth a lot of money, actually, a 20-year call option above your goal. And then you take that premium today, and that actually reduces the returns that you need to get to achieve your goal. So you shift your thinking from maximizing returns to increasing the probability of achieving your objective. And so the reason I'm saying it very generically like this is everyone has different objectives. It's not just maximize. The investment industry has come to this mantra of we should just maximize, maximize, maximize. Maybe, but you could also, if you have specific objectives, increase the probability you hit them. It's a different way to think about the same problem.
I have one more question somebody put on there, but before I get to that question, I just wanted you to touch a bit because I like this part of your book that you spoke about seatbelts in the blue zones.
Oh, yeah. Well, all right. So seatbelts. This is interesting. So one of the things that I've said happens is that a lot of us And the world has basically become a world of reductionist thinking. We all say, oh, let's just narrow in and look on this one part. And if we can optimize this one part, everything's going to be great. And it's sort of the logic of all else equal. Well, unfortunately, all else is never equal. And so the examples that I use and sort of suggest a systems thinking approach where you look at feedback loops. So for instance, all the public safety professionals concluded that if you wear a seatbelt, you'll be safer, car accidents will go down, or injuries from car accidents will drop, there'll be less death from motor vehicle accidents, etc. Maybe there'll be the same number of accidents, but what you find is that individuals actually drive more aggressively, even riskier, once they put a seatbelt on. Why? Because I'm safer. And it's the same logic that happens with helmets in the game of football, right? So here in the United States, football is very popular. And so you put on a football and the helmet, and then because of the helmet, people hit harder. So you put the helmets to avoid the concussions, and actually people hit harder and you continue to get same number of concussions. And so what you need to think about is that feedback loop that produces the very opposite of the objective you're seeking. And so that's something that I hint at there. In terms of blue zones, since you've asked Tommy about that. So blue zones are these portions around the world that they're called blue zones because demographers, when they were looking all over the world, they put blue circles around areas where there were disproportionately high numbers of people living into their hundreds of years of age. And they say, well, what's going on here? And then there were individuals who went and studied those blue zones. And what they concluded, which is really interesting, is was it diet that made these people live longer? Yes. Was it only diet? No. Was it exercise? Yes. Was it only exercise? No. Was it community? Yes. Was it only community? No. What you get to is a belief that actually that whole way of life, that whole community spirit with unintentional exercise, with a healthy diet, with, etc., all of that comes together in a way that shows the whole, the ecosystem, the whole systematic approach produces an outcome that no one of the parts is able to produce. You can have the diet of people that live in the blue zones, you won't live to 100 years. You can have the exercise routine, you won't. You can have the community spirit, you won't. Combine these all and suddenly you've got a recipe. So there's some magic in the accumulation of different things. And unfortunately, many of us in society look only at little silos, slivers, parts. And there's some magic in the whole, I guess is the part I was getting at. So
like a portfolio.
Like a portfolio, exactly right. Exactly right. The analysis at the portfolio level is very different than analysis at an individual asset level, which is very different than analysis at individual manager allocation or individual manager level.
So 2 questions before I let you go. I know you're a busy man.
No
First
problem.
question is somebody texted me, they calling me and texted me to ask you this question. Is NASDAQ going to hit 20,000? No, that's not the, but they asked if there's a lot in Canada. There's a lot of venture capital money that's looks to be going, especially in the Toronto area, around fintech technology. Canada doesn't have the population to sustain these business models. Yet so much money is being put into these business models and chasing monthly reoccurring revenues instead of looking at, well, not instead, but also to the bottom line, maybe to the detriment. And a lot of these businesses are great ideas, may become great businesses, but they need, a market, a consumer-based market like the US, and with NAFTA and everything going on, people are saying, well, a lot of these deals are available in the private market. What would you say to these kind of deals that are, it looks like the exit strategy or the liquidity event is going to be selling to Google, but if it doesn't happen, then they're toast. So,
yeah. It's a tough question, Tom. It's very specific. It's beyond my area of expertise or knowledge, but generically what I can say is, market opportunities today, particularly in the technology space, are far broader than the demographics of your local markets, right? I mean, technology is enabling us to do things in Canada that could be sold to billions of people globally. Right? I mean, that need not be the constraint per se. Now, specifically in fintech, maybe there's some regulatory issues, maybe there's some adoption issues, maybe there's some different constraints and nuances. But I don't have a great insight there to be able to be helpful. I think the idea of having one sole possible exit plan being sell to Google, that scares me. I wouldn't want that. But other than that, I don't have great insight.
No, and it's fine. It's just more the question on with, NAFTA, the NAFTA 2.0, and knowledge being shared so broadly that, you look at it, India has all these PhDs that are probably 1/3 of the price of, engineers or technology people in Canada, which are probably 20% cheaper than in the US as well. And it's competition of jobs. These jobs are not getting more and more. Yep. I think the question is more in that nature.
Yeah, well, what you're getting at, which is very interesting, is I do think that technology-based jobs obsolescence, or the pressure on employment that it's producing, is going to create a backlash. Now, that backlash may come in the form of regulations. I mean, look, Bill Gates said we should tax the robots. Maybe it's different things. Maybe it's break up big tech. Maybe it's slow down the productivity so that technology can't race ahead faster than we can skill our people. That actually,
how do you do that?
It's a race, right? No, it's hard to do. It's hard to do. It requires political intervention in a mass level that, is very hard to do. I think it's hard to put the sort of technology genie back in the bottle. Once we get autonomous driving, think of the number of drivers that will disappear. And it's not going to happen slowly. It'll happen rapidly. And so the pace of change is as problematic as the magnitude of change, because over time, humans can and have adjusted nicely, right? We always adjust. We're good at that, but it takes time. And so it's partially not the technological developments that I'm concerned about. It's the pace at which they're developing. I'm very optimistic about us as humans to adapt. I'm a little less optimistic about the pace at which we can adapt.
Final question.
Please.
Somebody wrote here, coming back to, I think, with the whole government bonds and negative yields, gold, grain, etc., can appreciate in value, but I'd rather leave cash in the bank and earn 0 versus buying government bonds to earn negative rates. Right?
Well, it depends what you have to have a view there on purchasing power of the dollar. I mean, what if you've got inflationary pressure coming? Then maybe yes, having 0 interest rates is like going down. Maybe that is your negative rate. But if that's the case, then you're right. The bonds will be more negative rates. They'll be even more intense if you have positive interest rates. You have to think about sort of what can happen to the cash. Is it really safe? If banks are going to charge you fees, maybe there's a cost there. Obviously cash, if you believe in the safety of it, then that is, of course, I mean, again, people use the term risk-free assets. I don't know what's risk-free. I just don't know what risk-free is, right? I mean, is the US dollar risk-free? I don't know. I mean, they've got some big deficits going here, some big money printing going on here. Yes, we're a reserve currency. Yes, there seems to be a lot of appetite for dollars around the world. Yes, seems to be we can do whatever we want. No one cares. Low interest rates, big debt levels. Yeah, it doesn't seem to matter. Well, it's not going to matter until it does. And when it does, the recipe we know for hyperinflation in the world that took place in Weimar Germany, that took place in Venezuela, took place in Zimbabwe, was deficit spending using borrowed money that eventually results in a devaluation of currencies that produces the hyperinflation that creates mass economic chaos. The United States has deficit spending using borrowed money, but has not seen the massive devaluation of the dollar. If we do, and that may be a good thing to leave people with, to watch, something to pay attention to, then you can imagine inflation will pick up quite dramatically. And that has the potential to be quite disruptive. So I think there's a lot of questions, unfortunately, hard to disentangle about gold, grain, dollar, and the bank versus negative interest rates. There's a lot of questions there. And so maybe hopefully I shed a little bit of light on a portion of it.
No, great job. It was a pleasure having you today. And like I said, great book. I think everybody should have it.
Tommy.
First 300 people are registered at PCMA will be getting your book.
Excellent.
And yeah, again, I thank you very much. Hopefully the next time we see you, it'll be in person and we will going for drinks.
I hope so, Tommy. I look forward to it. So thank you. Thank you for having me. And thanks everyone for taking the time to listen. Please don't hesitate to reach out. I'm on Twitter and LinkedIn if I can be of help and have any further questions. But otherwise, I wish you all the best of luck.
Thank you very much, Vikram. We'll be in touch.
Thanks.
That being said, we're looking to go to our breakout sessions right now, 3 breakout sessions. I think at the bottom of the screen, bottom of the agenda, you'll be able to see the links. One of them is Triumph, MNP, and New Look Capital. You are welcome to join in any which one you want. This marks the end of the main room, the main conference. I'd like to thank everyone for attending, the speakers, the panelists, the team of the PCMA, Nancy, Erica, fantastic job. Everybody I hope everybody's happy with the output that we produced. Some technical glitches, some a little technological stuff. Jason, fantastic job on the technology. Thank you very much, everyone. The sponsors, thank you very much for this for supporting this event. And I urge everyone to join one of the breakout sessions that they have of interest. I'll be in one of them. I haven't chosen which one yet, but thank you very much, and thank you for being here.